All right, so welcome back here to the Pass Your Life and Health Insurance Exam podcast. I'm your host, Biko. I'm very excited to have you back here today. So today we're going to talk about the difference between life insurance and annuities. So I have a membership here at Minzo Pass. We have three memberships. So today what you're going to see is a recording of the training with one of my VIP students. Her name is Josita. She's from the state of Maryland. So we're going to drill down deep, talk about the difference between life insurance and annuities, because on your exam you can expect to have at least one question, maybe even up to three questions that will expect you to know the difference between those two. So, and don't forget, if you're watching this on YouTube, don't forget to subscribe. If you're listening to this on the podcast, don't forget to follow. See you in the training. All right, so the first thing, what is the primary purpose? What is the primary purpose of life insurance? Can you tell me what's the main use of life insurance?
It's kind of security.
Security? Okay, what do you mean by security?
Um, because life insurance is how can I say? So I don't know.
Okay. So when you think about life insurance, the main purpose of life insurance is to provide a death benefit, right? Because death benefit. So when you die, when you have life insurance and you die, then your beneficiaries are the people who will receive the money, right? Those people get a certain amount of money. So the main use of life insurance is to provide death benefit. So the main use of life insurance is to provide death benefit. Now, other names for death benefit, you have to know this. Other names of death benefit, they can be called face amount.
Yeah.
They can be called policy proceeds. They can be called limit of liability. So on your exam, sometimes instead of saying death benefit, they'll say face amount, or they'll say limit of liability, or they'll say policy proceeds. Now, why do they call it face amount? The reason they call it face amount is back in the old days, long time ago, when they sent out your life insurance policy in the mail, the first, your death benefit was on the first page of that policy, right? It would say $1 million policy or $500,000 policy. So that was on the face, right? Because anything that's on the front is on the face. So that was on the face of the policy. So that's why it was called the face amount, right? So here, life insurance death benefits are called face amount, right? Another name is face amount. Other thing too is also called policy proceeds. Why is it called policy proceeds? Because we know that proceeds mean money, right? When they say you're getting proceeds mean money. And your policy is your life insurance contract, right? So, like for example, your rental contract with your landlord is called lease, right? In life insurance, your contract with the life insurance is called policy. So policy proceeds, it means the money from your contract. So another name is policy proceeds. Other name for life insurance is limit of liability. That means liability is how much the insurance company owes you. So that tells you the maximum they owe you, the limit is that death benefit. They can't pay you anything more than that death benefit. So if it's 500,000, 100,000, 1 million, they cannot pay more than that. So it's limit of liability. So know these three. Death benefit is also called face amount. It's also called policy proceeds. It's also called limit of liabilities. Okay. Those are very key to know. All right. So the main purpose of life insurance is to give money to the beneficiary when the insured dies. That's the main purpose. Now, we come here to annuities. The main purpose of annuity is to provide income for life or a specific time period or a specified time period. So we have a joke in the insurance industry that says if you want other people to enjoy your money when you die, life insurance. But if you want to eat your own money while you're alive, get annuities, right? So, so annuities is meant to give you money while you're alive, whereas life insurance is meant to give your beneficiaries money when you die. So that is the difference. Any questions?
So, so can I have the definition of annuity? Because the definition that I have is maybe different.
Okay. What's the definition you have?
Um, an annuity is a provider. According to me, annuity is someone that provide income for life or specific time of period. But yesterday when I was trying to study, they say annuity is a death. What was I saying? Is it death? The annuity is like, let's say, is someone or something, or is a provider, but it provides you, it insure you in case of accident, or maybe in case of accident. I don't know if you understand what I want to say.
Annuity provides you in case of accident. What do you mean? In case of
It
accident?
means that you have a specific illness. So if your illness is not due to an accident, annuity doesn't provide that.
That's not
It provide you coverage.
That's not annuities. That's probably accidental death benefit, but it's not annuity. Annuity is an insurance product that pays you retirement income. So we'll talk about the uses of life insurance, right? So again, it provides you income for life. So it's something you put. Let's just say you win the lottery, right? You win the lottery, you get a lot of money. You take that money, you put it in annuity. Then the insurance company will now, after some time, it can be 1 year or it can be 2 years, the insurance company will now start to give you a little bit of money every single, it could be every single month, every 3 months for the rest of your life, or it can be for a specified period of time. So annuities, the purpose of annuity is not to provide you, death benefit. Now, it can provide death benefit, but that's not the main use of it, right? So I think you're talking about the accidental death benefit rider, where if you die in an accident, then it's going to pay you double the money. But can you tell me where you read that? Was it in your notes or online?
It was online.
No, that's not annuity. Yeah. So just know that annuity is an insurance product that gives you money, that's meant to provide you money for the rest of your life, okay, or for a specified period of time. Now, let's come back here to your insurance outline, for your exam outline. So it wants us to talk about the accumulation period versus annuity period. We'll talk about that. But just know the purpose of annuity is to give you retirement income. So when you think about annuity, think about retirement income, right? Like the same way you have 401k, right? Your 401k is for retirement, right? Exactly. So it's the same way as annuity. So annuity is meant to give you income for the rest of your life or when you retire. And life insurance is meant to give you money. The money is not for you, but for your beneficiary. So you pay your premium every month, and then when you die, your beneficiary gets money. Now, there are other types of life insurance that will give you money while you're alive, but for your test purposes, just know that life insurance, the main purpose is to pay your death benefit when you die. And annuities, the main purpose is to give you money while you're alive. Okay, any questions?
No, sir.
All right. So now, so we have that now. So what are other uses? Let's talk about uses of life insurance. I think this one is on your exam. Uses of life insurance. Okay, so these are the uses of annuities, right? So let me just copy them here. It's on your exam.
Did you know?
This is that 98% of our students pass the life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll. So uses. So the uses of annuity, again, annuity can be used, and you have to know this because everything we're going over is on your exam outline. Okay, so annuity is used to provide individual retirement plans, as I said. So retirement is used to provide you tax deferred growth, so your money grows tax free while your money is almost like your 401k, right? While your money is there, you're not paying any taxes on it, right? So it grows tax deferred. Then also education funding. So it's used, you can use it to save money for your kids' college. And then you can also use it for charity, right? Where you can say, okay, you know what? I want, I want to, I want to give this annuity to someone else, right? So these are the 5 uses of annuity. You have to know them on your exam. It's used for individual retirement plans, right? So you can use your annuity for something called IRA. So that's individual retirement account and annuities, right? Or account. But just know it's used for retirement. You can use it for tax deferred growth. So if you don't want to get taxed on your money, the same way your 401k is sitting there, you're not getting taxed on it, annuities can be used for it, right? And in retirement, you can use it to save for your kids' college. For people who have children and they want to save college tuition, you can use it, and then you can use it as a gift. You can put money in there as a gift to give to someone else. So it's called charitable gift annuity. Any questions?
So what is IRA? It's individual retirement
account, individual retirement account.
Account, okay.
Yeah. Okay. Now we come here to life insurance. We'll say, well, life insurance, the primary purpose of life insurance is to provide death benefit, but you can also use life insurance. It can be used for retirement. Okay, so life insurance can be used for retirement. It can be used for all these things, right? It can be used for education funding. It can be used for, it can be used for savings. It can be used for all these things, right? All right.
Maybe so.
Yeah, so people use your cash value life insurance, your index universal life insurance. You can use it to save for retirement and as an emergency fund. So you can use it.
How can we use life insurance for savings?
Oh yeah. So for cash value life insurance, because with cash value life insurance, a certain percentage of the money you pay for your life insurance, about 60 to 70% go into your cash value. Your cash value is your savings account that's attached to your life insurance, right? So it goes into that cash value. So
it's the money that you can withdraw anytime.
Exactly, you can have access to that money. Yeah. Okay. So again, this is key. You got to know the main purpose of life insurance is to provide death benefit. Main purpose of annuity is to provide income for life or for a specified period of time. All right. We'll come back here. So we got this one crossed off. Let me see if there's okay, perfect. So that one is crossed off, right? Let's make it green. All right, that one is crossed off, and we got that one. Okay. All right. So now we're still contrasting life insurance and annuities. So who are the let's call them the people, or let's say the players. So who are the players? Well, for life insurance, you have your policy owner. You have your policy owner. You have your insured, and you have your beneficiary. Okay. For annuities, you also have the same thing, but instead of policy owner, they'll just call owner, or they'll call annuity owner. So your policy owner Another name for policy owner is policy holder. Okay, because a policy, again, your insurance contract is called policy, right? So your policy, then you hold the policy or you own the policy, so you're called policy holder or policy owner. So the policy owner is the person who applies for the life insurance. So this person applies for insurance. So when you're filling out the insurance application, this is the person who applies. This is the person who pays, or they have all the ownership right? So they have all ownership rights. So what are some of those ownership rights? Well, they get to pay premiums. They get to surrender the policy. So in insurance, surrender means cancel, right? So when you cancel your life insurance, it's called surrender. That means, hey, you know what? I'm surrendering my policy, right? So when you surrender your policy, then you've canceled your policy. All right. So they get to surrender the policy. They can, if it's a cash value life insurance, they can request loans. They can they can make withdrawals. They can assign beneficiaries. They can sell the policy or transfer ownership. Okay, so these are all things the policy owner can do. Now, the same thing with the annuity owner. They can also do the same exact thing. They have all the ownership rights. So I always like to give the example. When I was growing up, my mother always used to say, I pay the bills, I call the shots, right? So the person who is making the premium payment has all the rights. So this person has all the rights. Any questions so far?
No, sir.
Okay, so it's the same thing here so now for annuity, it's the same thing, right? The annuity owner is the person who apply for the annuity. Is the person who has all the ownership rights. So when you, the owner, you pay the bills, you get all the policy, you get to say, I want to cancel this policy. Again, I said surrender means to cancel. So when you surrender your policy, that means you cancel it. If the insurance company cancels your policy, then it's called lapse. But if you cancel your policy, it's called surrender. Okay. Now let's come here to the insured. Who is the insured? The insured has to meet two criteria. Number one is the person, the person whose life the insurance is written on. So it's the person that they have to take account, like your age, the health situation, all those things. It's the person that the insurance company will evaluate to decide whether to give this, to approve the application, right? Because we say life insurance is a transfer of risks, right? So just know the definition of insurance is a transfer of risks. So you're transferring that risk on to the insurance company. So insurance company is taking a huge risk, because if they insure you today and you pay your first premium and God forbid you die tomorrow, now they owe your beneficiary 100,000 or 1 million, right? So they want to make sure that you're not going to die tomorrow. You don't have major medical issues. So the person who they're going to use to evaluate them to make sure that their life is okay is the person whose life the insurance company is covering, right? So the person whose life the insurance company is covering is called insured. The insured is also the person who has to die before their benefits are paid out. Before their benefits are paid out. So as long as the insured is alive, no death benefits can be paid. Okay, as long as the insured is alive, no death benefit can be paid. So now this is why the insured and the and the policy and the beneficiary can never be the same, because if you have to die before you get the benefit, then how can you be dead and receive money at the same time, right? So
Impossible.
insured and the beneficiary can never be the same. So in annuity, the insured, we have an insured, but we call that person the annuitant. So it's the same thing, but it just had a different name, right? Now, so the annuitant here, again, is the person whose life the annuity is written on. So similar thing. So, and then it's the person who has to die before their benefits are paid out. Because the way annuity works is that whatever you don't use, let's say I'm getting 500 every month, right? Then if I die, then my beneficiary can get, we'll talk about settlement options when we get to that, right? But the good thing about annuity, you get to enjoy that money. You get to eat that money while you're alive. And then whatsoever is left over, your beneficiary gets. Whereas with life insurance, you don't get to eat anything. People only get to eat when you're dead. So, that's why some people don't like life insurance. They say, why should I suffer and you enjoy? I don't enjoy any of my money. But for annuity, you get to enjoy that while you're alive, right? So this person, again, the annuitant, has to die before beneficiaries are paid out. And then we say the annuitant is the same as the insured. All right. So we're making progress. Now we come here to the third person on our list. Yeah, the beneficiary.
Are you expecting me to write all those things?
Oh, no, you don't have to write. You can take a screenshot of it. Let me.
Or it's possible to copy it and maybe I'll send it to email.
Let me see here.
But not now, after, when we are done.
All right. I can send it to you later.
Thank you, sir.
So your beneficiary, the beneficiary is the person who receives the death benefit after the insured dies. Okay, that's it. So this person has no rights. Right? Oh, I forgot to add, the policy owner is the person who can also assign beneficiary. And then for annuity, it's the same thing. The policy, the owner is the person who can get to choose who will be the beneficiary. They can assign beneficiary, and they can also remove beneficiary. They can assign and change. They can assign and change beneficiaries. And the same thing for annuity. So they have, when you think about the annuitant, when you think about the owner, think about, you have all the rights. You can choose who you want to add on your policy. You can take out anyone at any time, the beneficiary, right? Mm-hmm. Also, the insured really has no rights. The person who has all the rights is the policy owner. And then the beneficiary, again, we say no rights.
The insured?
Yeah, the insured. Again,
the insured doesn't have, the insured is not the policy owner?
Well, most of the time, the insured can be the policy owner, but sometimes the insured is different from the policy owner, right? So, for example, if you get life insurance on your child, right? You are the owner, your child is the insured. If you get life insurance on your mother, right? So your mother is the insured, you as the policy owner. So sometimes you can get life insurance on other people. So you would own the life insurance, but those people will be the life, that will be covered. So when that happens, it's called third-party ownership of insurance.
Mm.
Yeah, it's called third-party ownership of insurance. So it's the same thing for annuities. The person who receives the death benefit after the insured dies, and they have no rights. Any questions?
Okay, talking about the policy owner and then the difference between the policy owner and the insurer. So I have this question. If by any chance, maybe it's a chance, but if by anything happens and then one of the insured, we lost one of the insured, is the policy owner, sorry, is the policy owner going to receive a death benefit for the insured?
No, you asked a very good. The policy owner never receives the death benefit unless they are the beneficiary. So sometimes the way it works is that you, as the policy owner, you can also be the beneficiary, right? So let's say you get life insurance on your child, right? Mm-hmm. So your child will be the insured, then you will be the beneficiary and the owner. So if something happens to your child, You will get the benefits, right? Or let's say your parent, you own the insurance, they're the insurer. If something happens to them, you get the death benefit, right? So it can happen like that. But if you are the insured and you are the owner, you also cannot be the beneficiary, right? Because remember, the beneficiary can only get the money if the policy owner dies. But if let's say I get life insurance on myself, right? So I'm the insured, the insurance is covering me, and I own it, right? Then it won't make sense for me to also be the beneficiary because how will I receive the money when I'm there? The only time the beneficiary gets the money is when the insured dies, right? But if I'm the insured and I die, then how will I get the money if I'm the beneficiary?
Because I'm asking that question because so maybe I'm in the house with the children and then I'm a policy owner, but I put the children under me, like I insure the children too, and then I'm paying for their premium. All of them have a premium pay. So in case something happened to them, they're not going to benefit from maybe accident or maybe they benefit something.
Oh, you ask a very good question. So you have you mean okay. So the insured is different from the owner, right? The insured is different from the owner. So those policies would not cover kids. So I mean, you say like let's say accidental death benefit or you have long-term care rider. No, it won't cover them because remember they're not the owner, they're the insured. Now, what people do is when that child grows up, when they turn 21 or so, they can turn that insurance over to them. So now you can transfer ownership. Once they own it, now they get all the benefits.
So it's a mistake to cover a child with a life insurance.
No, it's not a mistake. It's a good thing because you get it. The benefit of having it is number one, it's cheaper when you get life insurance for kids, right? So when those kids get to a certain age now, you can transfer ownership over to them, right? So instead of having to, because let's say your kid gets cancer, God forbid, right? You say, oh, well, I'm going to wait until the child grows up before I get him. But what if the kid gets cancer or has some major medical stuff? Now, when they become 20 or 18, qualify for insurance. Because most of the time when people are young, they're in the best health of their life, right? So you get them insurance while they're young and healthy. It's going to be cheaper, and you know that kids are almost always covered unless they have major medical problems. So you get them the insurance now. You lock in the low premiums, and then when they get out of college, that's what is usually preferred. Then you can transfer ownership over to them. And my mother did the same thing, right? When I was in high school, she got insurance for me. And then when I got out of college, she transferred ownership over to me. So now I was the owner and the insured. So that's what you do. But the insurer has no rights, only the policy owner. So if something happens to that child, let's say sickness or stuff, it won't cover. Again, it's just the policy owner. So the policy owner has to be this. For that to happen, the policy owner has to be the same as the insurer. And life insurance companies don't provide long-term care benefits for children. Most of the time, they're required to be at least 21 years and older.
Okay.
Yeah, but the insured has to be the same as the policy owner if you want to get. Remember, the insured doesn't enjoy anything. The only thing they're meant there to, they're pretty much there. Number one, for the insurance company to cover, and number two, when they die, for the beneficiary to receive money. But most of the time, the insured is the same as the policy owner. So, like for example, you get life insurance on yourself, right? Then that one is different. But if you get on someone else, then that's called third-party ownership of life insurance. So anytime you get insurance on someone else, the insured is different from you who own the policy. Whether you get the insurance for your parent, you get insurance for your child, you get insurance for your husband or your wife, or you get insurance for your business partner. Anytime you get life insurance on someone else that is not you, it's called third-party ownership of life insurance. And that will also be on your exam. Third-party ownership of life insurance. Any questions?
No, sir. Thank you.
Yeah. So we're going at a very slow pace, and the reason I'm doing this is because of your performance on the exam, right? Because usually if you score less than 50%, I go at a slower pace to make sure you really understand it. Because how it works that every time you fail the exam and you go to retake the exam, it'll make it more difficult. right? They'll make it more difficult. So you want to go your second time to really, really understand it. All right, so let's talk about beneficiary. Let's talk about who can. So as I said, the beneficiary. You can see here the beneficiary cannot, very important, cannot be the same, cannot be the same as the insured, right? So for life insurance, the beneficiary cannot be the same as the insured. It's the same thing for annuities, right? The beneficiary cannot be the same as the annuitant. They have to be different because you have to die before the beneficiary receives money. Now, the policy owner, the policy owner can equal the insured. So the policy owner can be the same as the insured. The policy owner can be the same as the beneficiary. So this is for third party ownership. So if the insured is someone else, then you can be the beneficiary. So third party ownership. And then the same thing here for annuity. Same thing for annuity. The policy owner can be the insured, right? The policy owner can be the beneficiary. If it's a third party ownership, right? That means that the annuitant is different from no. So let's give example: husband and wife, right? So I get insurance on my wife. So my wife is the insured. Now, when my wife dies, because I own the insurance, she is the insured. I get insurance on her, right? When she dies, the insurance company gives me money. I get annuity on my wife. When my wife dies, I'm the beneficiary. I get the money, right? So that's considered third party ownership. So anytime someone else's life that's covered, anytime the insured and the owner are different, it's called third party ownership. Okay, so yes, so third party ownership. So make sure you notice the beneficiary can never be the same as the insured. Let me highlight it here in yellow because this is very important. Just know that the beneficiary can never be the same as the insured. All right. So we cover that now. Also, let's come back up here. So we've covered these ones here. So we've covered owner, annuitant, and beneficiary. And we've covered so let's talk about, you have 2 periods in insurance, right? Well, before we get to that, let's come here to medical underwriting. What does this mean? So medical underwriting, the insurance company has to look at your health, make sure you're in good health before they insure you. Why? Because the insurance company, for life insurance, they're taking a risk on you. If you die early, it's a loss of them, right? Let's say you get insurance today, you pay your first premium, next month you die. Now the insurance company, let's say you pay $100. Now the insurance company owes a beneficiary $100,000, even though you just pay $100,000, but now the insurance company has to pay $200,000 or $1 million, right? So it's a loss for the insurance company. So the insurance company doesn't want you to,
Right.
yeah, the insurance company does not want you to die soon because when you die soon, it's a loss of them, right? So that's why they go, they do medical underwriting when you trying to get insurance. To send people to do exam, like check your blood pressure, your heart rate, do you have cholesterol, diabetes, cancer, all those things. They'll check it. They want to make sure you're in good health. So life insurance requires medical underwriting. Medical underwriting required for life insurance. The answer is yes. For annuity, the answer is no. Why I say no? Because the annuity company, they have nothing to lose because the money you put in is the money you get out. They're not risking anything, right? Let's say I put in $500. Maybe I'll get that 500 plus interest. So the insurance company is not putting any money up front, right? So what you put in is what you get. So they're not risking anything. So they don't care. You're sick, you're not sick, they don't care because you put in $1,000, it's $1,000 you get. So annuities do not require medical underwriting, but life insurance does. All right. So now let's go here to pure. So now we've done we've compared and contrasted the difference between annuities and life insurance. Very important. You have to know this, right? I can guarantee you one question on your exam will come from there. 100% guarantee. All right. So now let's now we've talked about life insurance and annuities. Now we'll change our change our focus to just annuity. So life insurance versus annuity. All right. So now we just go to annuities. All right. So for annuities, you have a period. So for for annuities, you have different periods. You have accumulation period. Maybe let me insert a table. Periods. You have accumulation period. You have your accumulation period, right? Accumulation period. And then you have your annuitization period. You have to know this because it's on your exam outline, right? So let's go into it. Other names. So they can also be called, your accumulation period can also be called your pay-in period. Your pay-in period. It can also be called your it can also be called, okay, your pay-in period. Let's go to annuitization period, right? It can be called your payout period, and I'll explain what that is, your payout period. It can be called your distribution period or distribution phase. It can be called your disbursement phase. Okay, so these are all different names for this. So we may be asking, when you get an annuity, you have two periods, right? The time you're putting money into your annuity, the time you're saving money into your annuity is called the pay-in period or the accumulation period, because you're accumulating money in that annuity. Every month you pay 500 or 100, right? You're putting money, so you're accumulating. So let's say this is the bottle, yeah, and then every time you're putting water in here, right? You're accumulating, water, right? You're putting in water. That's why it's called accumulation period, right? So during the accumulation period, the money you put there, growth is tax deferred. Okay, so you don't pay taxes on that money. It's tax deferred, almost like your 401k. Now you have the annuitization period. The annuitization period is where you now start to take out money, right? Now you now start to take out money. So you put your money there maybe for 5 years or 10 years or 20 years. Now it's time for you to start taking out money, and the annuity will pay you regular income for life, right? So whether it's $100, remember this is used for retirement. The whole purpose of this is to provide people income for retirement. So now whether it's $1,000 a month or $5,000 a month, you start to get money. That's why it's called payout period. So it's called annuitization period. Another name is payout period. Another name is distribution phase or distribution period. And another name is disbursement period. But all of them means the same. It means now you start to receive money. Now you go from paying the annuity company money to now the annuity company paying you money. Okay, so that is it. Now the money you get, the money you get during the withdrawal period, your gains or your profit is taxed. So let's say you put in 50,000 into that annuity, and you get 60,000 there's $10,000 profit, right? That 10,000 profit will get taxed. Congratulations. Now you just know the difference between life insurance and annuities. You know what is life insurance, you know what is annuity. Congratulations. If you study everything you just learned, if you master it, if you understand all of the information I just shared, then you should be able to pass any question that comes on your exam that requires you to know the difference between life insurance and annuity. So as I said, you can expect at least one question, maybe up to 3 questions on your exam that require you to know the difference. What you just saw is just a sneak peek of what I do in my membership. So if you like to sign up for our live training, you have the links in the description. Book a one-on-one consultation, or you can just go and just sign up for the membership yourself. Also, to let you know, if you're watching this on YouTube or you're listening to this on the podcast, remember to also subscribe or follow our TikTok page, because I go live on TikTok every day, Monday to Friday, 5 days a week. I go live. So you can come there and be able to ask me your questions. I can be able to answer all your questions. And sometimes I go live at least 1 hour every day. So that's a great way to come and learn and ask me all your questions, anything life insurance related. And I can be able to cover that. And we're running a special promo now. It's the end of the year. This was recorded in October. We just have, about 2 more months to the end of the year. So if you want to pass your life insurance exam, this is the time. So if you're interested in getting a discount, again, email me. You have the email in the description. But we're running a promotion right now where you can be able to save some money on your training. Okay? So remember, we have a 98% pass rate. 98% of our students pass. That is not fluff. I'm not making up stories. 98% of our students pass. You know the average pass rate last year? Last year, 50% of students failed their life insurance exam. So there's only 50% pass rate. So I almost doubled that. 200,000 people failed their life insurance exam last year. And here's the sad thing, right? Those people who failed, they didn't fail because they didn't study. Some of them studied for up to 2 months. They didn't fail because they were dumb. Some of them even have master's degree. They failed because they didn't understand the system. Because to pass this exam, it's a system, right? You have to understand that system. So we've cracked the code to passing the life insurance exam. So if you want to pass your life insurance exam without stressing, maybe you fail your exam 1, 2, 3 times, and you're like, you know what, I'm done failing. I just want to pass it this time around. Book a free consultation or enroll in one of our membership. We also have self-study courses. You can also check the link in bio or check the description and be able to sign up for some of our self-study courses. So I wish you all the best, and I'll see you for our next training.